Depreciation recapture. What is that? Hey taxpayers, it's Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale, and we're back with another installment of What is that? Where we discuss financial terms and topics you may have heard, but we make them super easy to understand. Today we're talking about depreciation recapture. This has to do with the IRS taking back a deduction that you previously took on an asset that you depreciated and later sold for a profit. So if you have an asset that you've depreciated or are currently depreciating and may sell in the future, this video is for you. Tune in and let's get started right at the beginning. Depreciation recapture. What is that? In general terms, depreciation recapture is a tax provision that allows the IRS to recapture taxes on a deduction that you previously took. The deduction allowed you to reduce your ordinary taxable amount. And so as a result of you selling an asset where you typically get a preferential capital gain tax, the IRS says, no, we need to recapture some of that and tax it as an ordinary gain. First, let's talk about what depreciation is. Companies purchase assets like computers and furniture and buildings. Individuals also purchase assets like real estate in a rental real estate activity. The IRS publishes specific depreciation schedules. So depending on what the asset is that you purchase, the IRS has a schedule in which you can depreciate or expense that asset over time. For tax purposes, annual depreciation expense reduces your ordinary income. And this also reduces your ordinary tax. When you sell an asset, you typically get a preferential capital gain treatment because you're selling an asset. However, if the IRS allowed you to do that without depreciation recapture, that would be a major loophole. You could take depreciation on an asset against ordinary income, and then when you sell it, only pay a special lower capital gain tax rate. So basically, depreciation recapture closes that tax loophole. So here's a great example. If you're a business that has purchased a piece of equipment worth $10,000, the IRS depreciation schedule says that you can depreciate this asset over 5 years, which basically means you could depreciate $2,000 per year. That is $10,000 divided by 5 years. So 4 years has passed and you've depreciated $2,000 every single year of those 4 years. You've depreciated a total of $8,000. This makes your adjusted cost basis in that asset $2,000. It's $10,000 of an asset minus $8,000 of depreciation you've taken so far equals $2,000 of adjusted cost basis. Now, let's say that piece of equipment is old and outdated at this point. You want to sell it and move on and maybe purchase other types of equipment. You sell that asset for $3,000. Most people would say, well, if I purchased it for $10,000 and I'm selling it for $3,000, I have a huge loss. I have a $7,000 loss, right? Wrong. You purchased the asset for $10,000. You've already taken a depreciation expense, a tax benefit of $8,000. So this $2,000 figure is your adjusted cost basis. Now that you are selling this asset for $3,000, your gain is actually $3,000 minus $2,000, which equals a $1,000 taxable gain. And here's the craziest part. This is what depreciation recapture means here. The $1,000 is taxed at your ordinary income tax bracket, not at a capital gain. Why? Because you've already taken $8,000 of a tax benefit against ordinary income, you now need to recapture this $1,000 gain against ordinary income. The rule is you have to look at two different numbers and determine which number is smaller to determine your depreciation recapture. The first number you look at is the realized gain from the sale. In this case, it's $1,000, which is $3,000 minus $2,000. And you also have to look at your accumulated depreciation, which we talked about was $8,000. $2,000 over 4 years. Which is a smaller number, 1,000 or 8,000? Clearly the 1,000. And so that's the amount of depreciation recapture that you must recognize as an ordinary gain on your tax return. Let's do another example. Let's take a similar scenario in which you've purchased an asset for $10,000. You're depreciating it over 5 years, which is $2,000 per year. Once again, in this scenario, 4 years have passed and you've depreciated $8,000. So, as we talked about in the first scenario, your adjusted cost basis is $2,000. Now, you've decided to sell this asset and you're in luck. The asset is actually currently worth more than what you bought it for. The asset is worth $12,000. Remember, you bought it for $10,000? So most people would say, well, $12,000 minus my $10,000 cost is a $2,000 capital gain. Wrong. Because you've already expensed $8,000 in depreciation, we have to factor that. You've already received a tax benefit. So now when we're doing the calculation, we have to look at what your adjusted cost basis is. $12,000 sale minus $2,000 adjusted cost basis is a gain of $10,000. The craziest part is that gain of $10,000 is not treated with capital gains tax rate savings. A portion of it will be, and another portion won't. So what portion will be treated as ordinary? The depreciation recapture. Because you've already expensed $8,000 of depreciation, you need to recognize $8,000 of the $10,000 in net gain as ordinary, and the remaining $2,000 is treated as capital. As you can see, depreciation expense is a beautiful thing. It really helps your ordinary taxes. But when you sell that asset, things can start to get tricky, and depreciation recapture will do that to you. And that's why it's so important that you have an expert CPA that knows all of these rules that you can consult with before you even sell the asset to really understand what the tax implication is going to be on that sale. Rest assured that you can rely on us here at Accounting to Scale as your depreciation experts. We hope you enjoyed this latest installment of What Is That? Hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.